What's going on, guys? Welcome back to the channel. Welcome back to another video. How many of you guys feel like we're being completely distracted right now? And like all of this debt ceiling crisis talk is just complete bull. And, you know, the Republicans, the Democrats, the Biden administration, they're all just trying to get everyone riled up and prepared for the worst right now, even though they both know that there's no chance that they're going to default on this debt crisis. I mean, plain and simple, I'm not buying it. And I'm not the only one who feels this way. Now, in this video, I want to talk to you guys about how to prepare for this looming crisis. Number one, how to get ready. But what we're embarking upon is one of the greatest wealth transfers in our lifetimes, right? And it's still underway, not just single-handedly because of this whole debt crisis, but this is one of many events that have been happening in sequence. Okay, pay attention, folks. By the way, if you guys are new to the channel, please consider subscribing to the channel, and while you guys are at it, go ahead and smash that like button. I would totally appreciate that. But if you're paying attention, this is one of these opportunities that's going to make a lot of people a lot of money. I'm just gonna let this bus go by. School's getting out. It's like the last day of school here. I'm not sure if it's the last day of school for you guys and your kids. One of the world's best market watchers says that there's zero chance that this debt crisis isn't resolved. All right. Now, I don't know if you guys heard what I just said because the bus was going by. One of the world's best market watchers says that there's zero chance that the debt crisis is not resolved. All right. So Wall Street has been basically wobbling under the weight of a potential U.S. debt default over the past few weeks. Investors are concerned that a deal to raise the debt ceiling could be hard to come by amid political gridlock in Washington. Worryingly, many House GOP members seem to be laughing off the seriousness of this threat, mocking Treasury Secretary Janet Yellen's apocalyptic warnings of crossing the X date when the U.S. debt would be defaulted on. Something, you know, kind of like a Ouija board. So, but Wharton professor, and I think Donald Trump went to Wharton business school. Anyway, Wharton professor Jeremy Siegel is not concerned. So the veteran market watcher has seen dozens of times this exact same scenario happen before, and he continues to believe that lawmakers will ultimately come to an agreement. He says that there is zero chance that the debt issue will not get resolved, even though there will be the posturing and debate right up to the last minute before timelines are extended for extending the debt ceiling. Treasury Secretary Janet Yellen has been using extraordinary measures to keep the government running ever since hitting the $31.4 trillion national debt ceiling since January. So basically, he ain't buying it. He ain't going for it. And I'm not going for it either, guys. And tell you what, funny thing is, and I don't know why this fly is bothering me because I've been out here all this time, not a fly out here. Here's the thing. U.S. government, at the end of the day, they can keep printing money. They can just keep going further and further into debt. It's all a game for them. Funny thing is the U.S. consumer can't do the same thing. And debt is how rich people build wealth. But you know, it's just funny because we can't do it the same way the U.S. government does. But we can play our cards right and be smart with this whole thing, right? It's all about preparation and being prepared. Now, I already checked out Walmart stock today. Walmart stock is up. Costco stock is up today. A lot of these retailers are still up today in spite of what's happening in the news right now. S&P 500, the Dow Jones, they're all pretty much just, you know, they really didn't move much today. Not even a full percent, not even half, not even a quarter of a percentage point in movement, right? So the question is, how do you make it out of this thing? How do you prepare for what's coming down the pipeline? And by prepare, obviously you want to survive this thing. But by prepare, I'm trying to win the game. You know, you got to understand the importance of how rich people accumulate wealth, right? You know, so if you look at consumer spending and its impact on the economy, that's like 70% of the economy, right? But you also have to take into consideration the negative effects of excess consumer debt. So basically, you know, Fed Chair Jerome Powell initially dropped these interest rates so low just to keep the economy from crashing, to keep the consumer spending. But now we're at a point where inflation's so high and they need to do something about it. So of course, Federal Reserve's cranking up interest rates. They've slowed down in the rate hikes, but I think that there's at least one or two more hikes coming down the pipeline still. Several banks have collapsed as a result of the aggressive moves. But while the GDP of the economy is 70% consumer spending, you got to look at the fact that too much of anything is not good, even too much of a good thing. And so, there is a negative side effect to excess consumer spending. It means credit card debt. If consumers spend more than they have in their bank accounts, they have to get that money from somewhere. They're going to borrow it from their friends, or they're going to borrow it from the banks or from the credit card companies. And eventually they'll get to a point where they can't pay it all back. And this is pretty much where the U.S. government is right now. U.S. government's kind of in a position where, hey, there's not enough right now to pay back what is owed. We need to raise this debt ceiling. Now, from a personal finance standpoint, there are some redeeming qualities related to debt. Correctly executed debt can lead to wealth accumulation and not just leading to bankruptcy. You got to understand, the potential for getting richer and wealthier through debt is possible. And we usually will see this pattern form in the form of real estate investments. Generally speaking, real estate is purchased through mortgages and creative financing to purchase real estate as an asset. Now, generally speaking, the paper assets like stocks, index funds, ETFs, that particular asset class is not usually leveraged to the extent that real estate is, but you can actually purchase stocks on margin. Many of the most popular brokerages allow you to do this. And of course, if you did, you could dramatically increase your wealth. You could also dramatically increase the rate at which you lose your wealth as well. Got to be very careful with it. So risk is associated with debt. But that risk that is associated with the debt, it lies with the people. So debt in and of itself is actually not risky. It's all about the person who's taking the debt out. So you got to look at the benefits, the pros and the cons of leveraging this debt, right? If you look at Silicon Valley Bank, they didn't look at all of the cons that could come with how they were investing their money. And basically, they over leveraged themselves. And then when interest rates were jacked up very quickly, thanks to the Fed raising interest rates, they were caught off guard, right? So you have to look at, okay, what are all the good things that could come from this investment, and also what are all the bad things that could come with this investment, and just make a smart call, and look at history. Now, I'm not saying that history is going to accurately predict what's going to happen in the future, but if you look at what has happened in the past, you can see what is likely to occur again. So, now one of the benefits of leveraging debt is you can, it's the ability to acquire a large portion of someone else's resources, right? Using a small portion of your own resources. Got the bus coming back through again. I'm just waiting for it. Well, that's going to be the last school bus for the rest of the year. Well, till, August. Anyway, so basically, you want to control assets without full ownership. And that is how you leverage the benefits of debt. You take a portion of your own assets, combine it with borrowed, or, you combine it with borrowed money, other people's money, debt, and you purchase the asset. Now, most consumers, they use debt in the wrong ways. They're using debt to acquire things that go down in value. They're not buying assets. And this is why a lot of Americans without assets were getting destroyed when the Federal Reserve began raising interest rates. First of all, if you can't afford to buy whatever type of luxury item that you're buying, it makes you wonder, why are you even buying it? And then on top of that, if you're going to use your American Express credit card or your Visa credit card, MasterCard to buy these things on credit, later to pay 20% interest rates paying it back, you're setting yourself up for failure. Meanwhile, the item you bought is not really worth anything after you've purchased it. Like, have you ever tried to sell a used pair of shoes? Have you ever tried to sell like a used, some used clothing? Like, good luck getting your anywhere near what you paid for it back. And so that's how a lot of Americans are using debt. But this is how Americans are getting screwed. Now, if we're smart, we're looking to acquire assets, leveraging debt, putting us in position to benefit from all of the benefits that will come from owning the asset, such as generating revenue from it, appreciation of the asset. Like, if you buy a house today, I mean, don't get me wrong, the housing market is probably going to have additional declines in the short term, but in the long term, housing market is going to go back up. Real estate goes up. It's just what it does. They're not making any more land, right? And so as real estate continues to appreciate, you're benefiting from that as an owner of that asset, even if you use leverage or debt to acquire that asset. Then you got depreciation. So let's just say, okay, you buy an asset, you put a tenant in it, you have a single family residence, a duplex, a triplex, a quadruplex, you put a tenant in there, you're making $500 or $1,000 a month in cash flow from that property. Maybe your revenue is something like, I don't know, $5,000 a month, $6,000 a month, whatever the case is. On your taxes, you can benefit from depreciation, which basically allows you to, on your taxes, lose money and reduce how much taxes you're owing, but at the same time, you're profiting in your bank account, right? And this is what the rich do all the time. They're leveraging these different benefits of asset ownership, right? And you got long-term debt positions, and these tend to favor the borrowers through amortization. So basically, your property is going to be going up over time. It's going to be going up in value over time. Meanwhile, the rate at which you're paying the debt off increases over time. And ultimately, if you're doing it right, the debt is being paid down by the tenants or whatever is generating the cash flow off the asset for you. In this example, it would be your tenants, right? And here's the other thing. The Fed doesn't want to get rid of inflation. Don't let them lie to you. The Fed is going to always have inflation. Their goal is 2%, not 0. And inflation, and this is why the US government loves inflation. The real reason is the inflation aids in paying down the debt, just like it aids the wealthy and the rich with paying down their debt. As rents are going up, landlords are able to be a little bit more aggressive with paying down their loan, or they can just reinvest this extra capital, this extra profit from their properties to acquire new properties, new assets. And and it's not just the landlords. I mean, look at very successful Fortune 500 companies leveraging debt for growth. You got Apple, Microsoft, Amazon, Tesla, Boeing, Walmart, Costco. They're all doing the exact same thing. They're following the same model, right? And they're borrowing money. They're borrowing depreciating assets, which is currency, to acquire appreciating assets, which is inventory. For Amazon, for Costco, for Target, for Home Depot, it's inventory. But if you're in real estate, then you're borrowing depreciating assets or currency to acquire appreciating assets, which is real estate, single family homes, duplexes, triplexes, quadruplexes, right? And these there's 3 controllable assets for debt investment. You can invest in yourself. Some people went to school, student loans. Depends on what you went to school for, determines how well your return on investment was. If you went $150,000 in debt to learn how to do basic home economics, that probably wasn't a good return on your investment. If you became a anesthesiologist and you're making $300,000 a year, okay, not a bad rate of return, right? You can also use debt to invest in your business for business improvement. Maybe invest in more inventory, invest in better systems, purchase real estate. So we have to look at how the debt is used, not so much that there is debt, right? So too much debt can be a problem. But even more important is, how is that debt being used? So these are some of the things that we need to be looking at. So if you're carrying a lot of consumer debt, if you're carrying credit cards, high interest credit cards, I'm looking to pay those suckers off. I'm not going to make these banks rich, paying them 15, 20, 25, 30% interest. Are you kidding me? No way. No way. So I'm looking at, and I don't carry any credit card debt. I use my credit cards on a regular basis every single day, but I pay them off every 2 weeks, twice a month, and I don't pay any interest on them. And these allow me to take free vacations. I build up so much points from funneling all of these expenses through these credit cards. Next thing you know, we take trips all the time for free. So, but these are some of the things that, regular people like me and you can do and benefit from this, right? So eliminating high interest credit card debt, investing in the stock market, S&P 500, leveraging, and I'm not an expert when it comes to the stock market. I don't need to be. I invest in index funds. I invest in ETFs and mutual funds. I like to keep it simple and let the experts be the experts. And I buy the asset classes or invest in the asset classes that have already been basically proven to be successful, looking at the track records of performance of the assets that I'm talking about right now. You can look at the last 10, 15, 20 years of many of the ETFs and ETFs and index funds that I'm invested in. You can see, wow, they've made 8, 9, 10, 12% interest over the last 10 years, 15 years. That's good enough for me, guys. Aside from that, I'm looking to increase my income by increasing my skill sets and continuing to build businesses. To me, that's the pathway to freedom. Drop me some comments, guys. Let me know what you guys think. Is this making sense to you? Is this making sense? If you want me to go in more depth in any particular segment of what we've discussed today, definitely drop me some comments down below. I'd love to hear from you guys. If you made it this far in this video, and by the way, you should see a video here and here. If you do see that video, click those videos, check out the next one. Drop me a comment, guys. I love to hear from you. I love to hear from you. If you have questions, drop a like for the video. Also subscribe, and keep your head up, guys. Let's stay positive. You got this.